start with the simplest of questions which all of us would have. I'm assuming there are a lot of successful investors here who put their money on December 4th, 2013 or earlier and continue to invest money with their portfolio managers systematically or with their PE investors, as the case may be. The question is, should I book out? Am I likely to see a repeat of 2008, January 2008 trend? Prashant, that first question to the successful investor. Is it time to cash out? And what do you mean by cash out? You cash out and go where? How does one approach? Is the question itself worded wrongly?
When you say should one book out and reduce exposure, my fundamental belief is that no one probably can forecast 1 year returns of the markets. It's easier to forecast 3-5 year returns of the markets. It's correct that equities are up 30-35%, but it is also correct that Sensex is up 30% not just over last 1 year but also over last 6 years. So in Jan 2008, Sensex was 21,000 and today it is 28,000. In these 6 years, the nominal GDP has more than doubled. Sensex is up only 30%. The PE multiples, when you last referred to in 2008, it crashed. Markets were trading 25 times. Today markets are trading 16, 17, 18 times maybe. So it's not a comparable situation. And finally, today if you look at the corporate profitability aggregate, it is at a 17-18 year low. So I think the outlook for profit growth, even though things have not changed yet on the ground, but over time there are reasons to believe that things will improve. So I would simply say, I don't know over 1 year periods, but if you do have 2, 3, 5 year views, and if you have tolerance for some volatility in the short to medium term, I would see no reason why one should sell out from these markets.
Well, let me get Mr. Bharat Shah into the conversation. Mr. Bharat Shah, how should the question be phrased in the mind of the investor when he approaches a fund manager or a portfolio manager? What should he be expecting out of you? Should he give you 10-year time? Should he expect from you 15% returns? What are the numbers that he must have in his mind?
I think first and foremost we have to appreciate equity investing is not a short-term game. It's not a temporary commitment or a parking place that you are into, or an opportunistic stance that when it is convenient you get into the game and you leave the gravy train when it is inconvenient to you. That kind of a mindset is one of the biggest killers for poor performance of the investor portfolios. If the equity investing is long-term and it flowers and shows the ultimate results only over a period of time, it is logical to expect that the investor money which is backing that portfolio has to be long-term too. Then only there is a synchronization of objective between what a manager tends to do and what an investor, his own psyche, his own temperament, his own attitude towards that investment is equally critical. The synchronization of the two is the ideal combination which lets the good results flower into the great ones. And Prashant mentioned that it's not 1 year is too short to predict, and I can't agree with him more. It has become a fashion or constant search and attitude to find a prediction about a short term. The irony of the investing is that the long term is far more crystal clear than the short term.
How should an investor, even approach times which look very frothy, times which look, expensive, where you have seen a 50% rise in some stocks? In fact, actually 600 to 800% rise in the past 1 year. So should he therefore steer or not invest in those times, or should he, wait for a dip? What should be the philosophy in times like these, which appear to be frothy?
Yeah, good. So investment philosophy doesn't change with the time. Investment philosophy is timeless. So every manager has his own investment philosophy. So and if there are 1 million guys in the market, there are 1 million ways of making money. investor has a fantastic choice to go to any number of manager. So I can speak about only my style of investing.
Please.
Which is QGLP, we say quality, growth, longevity, reasonable price. And I go exactly in the same order when I look at the stock.
Quality, growth, longevity and?
Quality, growth, longevity at reasonable price. It's a well formulated policy for me. Growth is very important. And then longevity of the growth. Longevity of the growth and longevity of the quality of the business and management. You know, I mean, like in commodity business, you have fantastic business in 2003 or 2005, but today same business are looking very bad. So what is the longevity? But Nestle or Britannia or all these companies, they would become better by the day. So have you got a quality company in this kind of environment which is becoming better? So when all these three things are taken care of, then only I get into the valuation, not before that. And then valuation is function of how much money the company is going to make. See, ultimately you are going to make only as much money as much the company is going to make. Nothing more than that. People are trying to make a company which makes 8% return on equity or 10% return on equity or 15% return on equity. They want to make 40-50%. It's just impossible. You have to get a company which is creating value over and above cost of capital, and then they have a business model which can grow at 25-30%, and that will be a return in the portfolio. So now the issue is that even at 30p I am willing to buy if a company is growing at 25% and ROE is 30%.
If you get your QGL, your quality, growth and longevity, then you are willing to pay a higher price.
Yes, much higher price. I can buy 40p, I can buy at 80p. Give me the variables.
Madhu, what should be the asset allocation and the comparison between property and equity?
I think this is more questions from an investor point of view, that everything else is a function of what are you holding and what percentage of equity and other assets are you holding. So if you are too intelligent and if you are like a normal investor, which most of you are, and if you allocated, let's say 1 year back 70% of your funds into equity, and that has become 99% of your portfolio today, then the question is very different. That, for that investor, even someone like me may advise that भैया थोड़ा पैसा घर में ले जा. But if you are someone who has only invested with the best fund in the best stock, saying that it has gone 10 times, but I invested only 1% of my wealth in that company, and out of my total portfolio, I am holding 10% equity and 90% is real estate or fixed income, then the advice is that if you miss this boom, and if you have, as a lot of learned people on the panel said, that if you have a real intent of investing into equity, which is only from long-term perspective, then even 8500 Nifty is cheap. If you have a 5-10 year perspective, then because your allocation is so low, that you have no choice. You can't keep waiting for the correction and the fall. So बहुत सारे लोग wait ही कर रहे हैं. And the other point, which is a general point, Lata, which you said rightly, most of the people, even in this room, and a lot of you are very intelligent, you learn, you run very, very successful enterprise and businesses. I find a lot of people have a significant overweight in real estate. Forget all of you, even I have a significant overweight in property, because the house in which I live is very valued, essentially. So I am saying, for the people who have significant overweight in real estate, clearly last 10 years were golden era, even for real estate. People have made 10, 20, 30, 40 times return, even on real estate in 10, 15 years. I personally feel that over the next 10 years, clearly equity should significantly outperform, 10, 15 years, significantly outperform the real estate as an asset class. Now the question is that, if you are willing to say it in 1 year or in one pocket, if you get something in SRA at 2,000 rupees in Goregaon, then you are likely to do well, but I am talking about general public. So the dilemma in minds of investor today is that if I have got significant overweight in real estate, is it still the time that I can switch from real estate to equities? And my answer is Yes, you must.
Your most important philosophy, there will be of course many lessons, but one big lesson that you want to give investors.
I just add one thing, because if you're wanting to sell to re-enter 10-15% lower, please don't do it. I think if you're selling for good, for reallocating, for your need, for whatever need which you need, then I don't think you need to ask anyone. But if you're trying to time it, कि बहुत बढ़ गया है, थोड़ा बेच देते हैं, थोड़ा घटेगा, फिर वापस ले लेंगे, so that is not to be done. The most important thing which I have learned after losing a lot of money in my career is the difference between risk and volatility. Many often a time we confuse volatility with risk and risk with volatility. If you are an investor, volatility actually is an opportunity for you. If you can recognize this, that you are in this
What
game.
is the difference between risk and volatility? Volatility is what the market brings and risk is what is inherently bad about the investment.
Risk is what you do unknowingly and you think you are doing it intelligently. That you buy a bad company just because it is in a fashion, or you buy something which is in a huge momentum, you can't control your emotion and you give in to that tip. ये बोला है बॉस 100% ऊपर जाने वाला है, and without doing your homework you said that I have to buy this company, where you didn't understand what the risk could be, and there are umpteen number of examples, I don't need to give name.
Mr. Shah, your most important philosophy, there will be of course many lessons, but one big lesson that you want to give investors.
I think investing is all about quality. It's only good things that get better with the time. The mistaken belief that you can generate returns by owning something which is rubbish is an essentially very flawed idea. It's only if a business is creating a real value that you can hope to have any investment returns. And if the business is not creating real economic value and yet you have investment returns, then you can be assured that those are ephemeral and you are soon going to be losing all of them. Equally, it is impossible that the business creates a lot of real economic value and somehow it doesn't get reflected in the investment returns of the price. Neither of them can happen. Eventually, the real economic value being created by a business has to reflect in the price, and there is no other way it does. It's only the question of how long it takes before it does so, and whether you have a mindset and a discipline to really align to that reality.
Raamdeo, your most important lesson from the markets or on investing?
So I think one of the things is don't focus on a stock, single stock. Buy a well-managed portfolios, whether it is called PMS, whether it is called mutual funds, but buy a portfolio because one stock can go wrong, but not a combination of 15 stocks. That's the power of well-managed portfolio. And a lot of people, they think that if tell me the next Hero Honda, tell me the next Bharti, I don't think it is going to work for you because we are doing it 24/7 and we might exit whenever it happens if something goes wrong, but you will not be able to exit. And there is a lot of focus, a lot of liking in India about individual stock investing, as if they are gurus of that particular stock. So, I think one must move, become mature, and I think buying a chosen portfolio of a high quality stock is the way to go, and that almost guarantees a safe passage for the investor. That would be one, and second is that don't time the market. If you have decided to put 100 crores tomorrow, do it tomorrow 9:15 and be done with.
Time in the market is more important than timing the market. So is there no concept called timing the market at all?
We can qualify that. See, it's very simple. P multiple is a very simple, very effective tool. If you look at it, markets in aggregate. When you don't look at P's for individual companies, it is more complex. But when you look at P's for markets in aggregate, I think it has very high predictive ability. Not over 1 year periods, but over 3 and 5 year periods. And I think time and again we have seen, and I think it should continue to happen in the future also, that the higher the P in the market at which you are investing, the longer should be your investment horizon. So I have seen that at closer to 11-12 P multiples, even 1-2 years is good time. The moment you come 15 to 20 years, 15 to 20 P multiples, one must think 3 years or longer. If you choose to remain invested at 25 PE multiples, you must think 5 years or longer. If you choose to remain invested at 30 P's or more, you must think 10 years or more. So I think the higher the P's, the more should be your tolerance for volatility and the longer should be your investment horizon. I don't think there is any one answer to this.
Do you think we are in the start of something transformational? Does it feel like, say, 91, when the whole grammar of investment in India or the Indian economy itself changed? Does it feel like that?
Do you still have a doubt? I think that you don't really need an expert to tell you, that Mr. Modi's coming is transformational. Even my driver can tell. So I think there is absolutely no doubt, and there should not be absolutely any doubt in anyone's mind that this is the best thing which has happened to India in last 200 years. And I repeat, in the last 200 years, this is the best thing with this country has happened. And let me tell you, I believe there is a bigger reason, because we are all Indians are God-fearing people, and this country was really cornered just 6 months back. Maybe the prayers of 120 crore Indians have worked to produce this. So I would go to that extent of saying that. So I don't think there is any doubt in our mind. However, I slightly disagree that...
And in transformational times, equity is the best time.
Yeah, and I don't agree that you can never time the market. I think there are times, if you try to time it every month, every quarter, then it's a trader's job. It's not an investor's job.
I really want your philosophy on time, and
that's why I'm saying I will time it once in a while. Like, last August was a brilliant time without even Modi to allocate disproportionate, because at 5,100 Nifty, if you are under-invested, even if you assume that Mr. Modi is not going to come, but India is going to be what it is going to be in the next 10 years, you would have still ended up making a lot of money. But suppose, let's say, in this euphoria, if Nifty goes in the next 1 year to 25,000, just hypothetical number, I would love to time it. Maybe the market has discounted, as Prashant said, that if you are in next 1 year with a 30p, I would love to say that you please take out some money from the table. But the rote is trying to time it every day, every month, every quarter. Once in a while you get an opportunity to time the market, and that time you must exercise it, and clearly this is not the time to exercise that.
Well, Prashant, you gave us a very nice timetable of how to think of time. But on this theme, that are we sitting on the cusp of something very big in terms of growth, in terms of equities, in terms of investment?
No, I think clearly the outlook for the economy is very good, in my opinion, and I think we have a great government. It's a very, there's a lot of capability, confidence, desire, and the power is also there to be able to do what you want to do. So I think we don't have any concerns on that front. India is one of the best demographic profiles in the world. And outside of Africa, we have the best demographics. So I think the underlying growth drivers in India have always been good. They are very good today. Indians are a very smart group of people. So the two IQ heavy industries, let's say like software and pharmaceuticals, Indian companies are close to the best in the world. So it's not just age, it's also smart people, capable people, and good government. Last 10-15 years should be good. I think this fall in oil prices, as Raamdeo was saying, is, I am surprised rupee is still where it is in a way. Yes, the dollar has appreciated, but if you adjust for the fall in oil prices, India is the largest net importer of oil across all emerging countries in the world. So we imported oil of 5% of GDP last year, that's $107. If you're building $70 or $80, current account should be near balance. So I think even the external environment has become extremely benign for India. By 2020, India should be the world's 6th largest economy. And in my opinion, I am not a great economist, but my rough calculation suggests that in the next 2 to 3 years, our growth rate should cross China. So I think when you merge the size of a 6th largest economy or 7th and one of the fastest growing economies in the world, it will remain a very compelling investment destinations. And I think P multiples are not yet pricing in this kind of growth. And one last point, corporate profitability in India is at a 18-year low.
Is that a
18-year low. Yeah. So if you look at the percentage EBITDA margins of all the companies put together, it is at 18-year low because of weak capacity utilization, high inflation, high wage inflation, currency depreciation. If you put all this together, so I think mean reversion in corporate profitability can also surprise some.